the audit. We've got no apologies today, the full team, so there's no resolution required. There's been no further declarations of conflicts of interest. There are no matters lying on the table, and there's been no request for a public forum. So next item is just the confirmation of the agenda. So I'll move that the agenda be confirmed without addition or alteration. Bill, your second. All those in favour? Aye. Carried. Thank you. And then we've got the confirmation, the public minutes of the last meeting. Got a meeting. Move it there. Lyle. Second or second. All in favour? Carried. Thank you. No, you can't. Yep. So done that. So moving next to our risk and compliance update. Gareth, welcome.
Thank you, Board Chair, members of the committee. Through you, Chair, there's just a couple of matters that I want to draw the committee's attention to, and then, if you're comfortable, I'll take the balance of the report as read. So firstly, just to remind the committee that our updated version of the risk management policy came into effect on the 1st of July. That was adopted by Council a little while ago. We allowed ourselves a transition period. There's obviously additional components in the policy around risk interconnectedness and specifically risk appetite, and obviously getting the business familiar with that through things like lunch and learns before it went live on the 1st of July. We've also been watching a number of tier 1 risk drivers through this period, and as the report outlines in section 4, we haven't changed our risk status for any of those, but we have been giving them some attention. They won't be of a surprise, I wouldn't think, to the committee. So central government reforms, economic impacts and prosperity are 2 of those. And then, as is touched on in the health, safety and wellbeing paper, threatening behaviours towards employees.
Yeah, that's a big one. Yeah.
Through the period, we've also identified 2 new risks. They're set out in section 6. One relates to operational technology, and the reason for that new risk is to distinguish operational technology. That's technology that supports our for example, 3 waters, assets like pump stations and other control mechanisms from IT technology, which is obviously the standard systems technology we have for council systems. We're currently in the process of evaluating that, so we're not in a position to give you a risk rating at this stage, but that is underway, and obviously I'm working closely with the knowledge management team in that regard. We will obviously bring anything back to the committee that's material in due course. Just finally, just wanted to touch on something that's actually been picked up through our audit report, which is on the agenda today around second line assurance. So we have a new risk that's been incorporated onto our risk register. It's set out in section 6 around lack of clarity for the ownership and responsibility for second line defence activities, I suppose, for the better phrase. I don't have anything else in particular, but through you, Chair, happy to take any questions that the committee has.
Okay, we'll open it up to questions.
Mr. Chair, just on the loss of integrity of our property and infrastructure assets, I understand you indicated there's work going on there. This has just come to light, historically. Records were kept, I guess, on paper. I'm not sure, but we've got some incident recently where, for example, on the P&I, the Frankton Track Water Project, we've got to buy land because there's infrastructure under that. So this technology, just want the comfort that that's going to, once we get all this IT and everything update, the as-built and all that will be clearly kept in a good place, and we won't have incidents in the future where we've got infrastructure under private property or things like that.
I'd probably answer something here. I mean, we're a long way from paper.
Yeah, I realise that. I've been not obtuse, I was being, putting it out there that, you know.
Context.
Yeah.
And I think, you know, certainly our GIS systems, and into what's called ECM record keeping, information management is certainly, moved a long way. And I think this is more about actually identifying, the risk, as a separate entity, and, more about, making sure that we have mitigations. We do have mitigations in place, but actually, capturing that. Would that be fair, Gary?
Yeah, absolutely. And that's, I suppose, an important thing to note is we're not saying that there's a new risk in terms of that. It's around documenting a risk and then understanding where it sits. So that's the purpose for raising it at the committee today.
Okay. Other one's more of a general question, Mr. Chair. Just, you know, it's great having all this system in place. It's just really just getting the comfort that you identify the risks, we've got actions and closing the loop. And who checks that we're actually taking action to address the risks? How does that come back through you? And just a very simple answer would be good.
I'll try and keep it very simple through you, Chair. Essentially, that's my role in the risk function. So I meet quarterly with all of the tier 3 managers and some of their teams as relevant. We go through all of the risks on the risk register. We prioritise that, obviously, based on risk rating. We look at treatment plans. We make sure we document treatment plans. We then look at what the residual risk rating is. So, yeah, broadly, that's my role.
Okay, thank you.
Thanks, Gareth. Another good report. I think around lack of clearly defined second line assurance roles, having read the internal assurance audit reports, which are, I think, a great boon for this committee in terms of what they identify. The issue around lack of implementation of recommendations. If you go through the operational risk, you can probably see it in different places, but is there like a key risk around implementation of internal assurance audit reviews? I mean, in terms of the internal assurance reports, identifies an area where finance can actually lean into something, which is the second line assurance. But more generally, you know, there's a whole set of recommendations that comes from each audit. Who's responsible for ensuring that they get implemented? And how is that picked up in the risk register?
Happy to respond to that. So Mariano periodically reports back to the committee around the status of the actions or recommendations that come out of his audit report. Mariano, our internal auditor, tracks those and keeps those with those actions accountable for closing those out. As necessary, we escalate those. The audit reports that you see on the PX agenda today are fairly new. So you already see that some of the immediate actions as outlined in that report have already been closed out. There's some that take longer. And one of the reasons for that, as you rightly point out, is as the risk in this report identifies, having clarity for who's accountable for second line assurance is really critical. That can sit in the finance space. And obviously Tech 1 provides inherent controls in that regard. In other cases, managers need to be accountable and understand what that means and that they're taking on a function of second line assurance, but that's the case.
Any other, Lisa?
Thank you. Sorry, just my questions, Gareth, a quick follow-on one to Bill's, that second line piece, when will that come back? When will that piece of work come back to us that you?
Again, through you, Chair. We're currently working through that risk. It's fairly broad. We have only recently, as you know, through the risk management policy, so we've talked about it for a little while, the risk management policy only formally recognises our 3 lines model for the first time from 1 July. I think if I said we would have that by next committee, that's probably fairly optimistic because second line controls sit across all of the business. So we'll work through that as quickly as we can. Obviously, I can give you an update at the next meeting and let you know when that's likely to be. But at this stage, unfortunately, I don't have that answer for you.
Thank you. Excuse me, thank you. That gives me a bit of an indication as to the scale of work you've actually got to undertake there. And yeah, my main thinking area in reviewing the report, and a really good report, thank you. It just gives us more clarity every time we get into it.
I'm really coming at, yeah, a bit of a reality check for myself really around that, risk 121, you know, our water services risk still remains really high and, you know, that speaks to our local vulnerabilities. And I suppose I want to understand a little bit more about what's still driving that really high risk. Like, is it operations? Is it governance? Is it compliance? And if you would be able to speak into a little bit around how our current models out for consultation, CCO will remain in-house. How do those models let us do water better? Like, is any of these new approaches actually going to be able to have an impact on bringing that very high risk level down? What are the main drivers of keeping it up in that high risk bracket?
Sure, happy to respond to that. Really useful thing for the committee to consider in terms of why this risk set's high. At a future workshop, we're going to go through and look at some of the interconnections with risks. So this is one that is relatively highly interconnected with other risks. So the other risks that I suppose are relevant here is affordability in terms of being able to deliver infrastructure, implications for rates. We've already touched on as a committee the challenges around the existing DCs model, for example. We're also obviously in the position of bringing good people into the team. We now have a really well-resourced team. We now have processes and systems in the operations and maintenance team that we've built over years. We're looking at the risk, and that's one of the reasons that we looked at it for this period to see whether we've actually taken the risk level down. It's actually the team itself that have said, let's let these new processes embed, and then we'll make a decision as to whether we've actually reduced the risk level. So it's probably a combination of a lot of things, but those are the two principal ones I would think are worth touching on today.
So affordability, resourcing, probably the things that
Capacity,
keep it in that,
capability, historically, yeah.
and that high level, yeah.
And then in terms of your second question, obviously the affordability, and I touch on this in the report later in the insurance space. One of the drivers, obviously, in terms of the new delivery model is to improve the model from a financing and affordability perspective. That could or should, it's intended to reduce that risk, and that's obviously something we've considered through recommendations for our model for delivering three waters in the future.
And just to reinforce that that is over time, obviously, yeah, over a period of 10 years.
Thank you. And yeah, one last question, and it's around that new risk operational tech. Are those assets that we own, or are they by other
Yes,
parties?
so-
And do we maintain asset registers around those sorts of things like SCADA and stuff, or are they? Yeah.
So through you, Chair, most of the operational assets we own. We have some communications technology that's owned by a third party, and that's part of the component that we look at from a risk perspective. But principally, most of the plant, if not all of the plant we have internally, is in our asset register. We manage that. We understand the status of those plants, how they operate, when they might need to be replaced. That's all managed very effectively through an asset.
So we have actual oversight across those tech pieces.
Yes, we do.
Yeah.
We are actually just working on new technology for our asset management, which is an enterprise asset management system under Technology One. And we're just starting to progress that piece of work, which is great because that's going to speak right across the enterprise system within QLDC and into finance, etc. But a big change piece that we're working through.
Thank you.
Yep.
Thank you, Stuart.
Okay, any further questions? If not, we've got to move to note the contents of the report bill. Lisa, your second. All those in favour?
Aye.
Carried. Thank you. Thank you.
Thank you.
Yes, that's great. Next item is the Queenstown Airport Capital Program update. So. Yeah.
Let's have a look. I don't think we get it. Yeah.
Well, what we might do then is move to the
Right.
Treasury. Yeah. So Miles, if you could step up, that's great. And Patty? Come on in. Morning, everyone. Still going for it, it's
Well, actually, I know I always say that, and funnily enough, since I wrote the report, not too much has changed. It was, but well, since I spoke to you last and presented in February, obviously, and especially over the last.
You just go back.
Keep going.
Carry on.
Yeah, it's been an interesting 3 months. There was a saying from Vladimir Lenin back in the early 1900s. There are some decades when nothing happens, and there are some weeks when decades happen. And I think it's probably appropriate to what's happened in the last 3 months, especially in early April. Now, you've read the report, you know what's happening overseas, but I mean, from a financial market perspective, I think it's probably important to note that the volatility that we saw in early April in the US bond market and in the share market, but the volatility the day before the tariff announcements, the US 10-year Treasury bond yield was at 3.88%. And a day and a half later, it was at 4.5. Now, that is just, you know, from our perspective, you know, I was incredulous when I saw what was happening. They have a morning and afternoon session. Now, the afternoon session was when it was rising stuff, the tariffs were announced, was the biggest move in an afternoon session in 38 years. It was not since the share market crash in 1987. It got the US, because the US 10-year Treasury bond yield is the global benchmark for long-term interest rates. Now, it did come down to, I think, about 4.2 at the moment. I think it was 4.47 when I wrote the report. It's 4.38. So the volatility has actually come down a little bit. The markets tend to push the rate up when they're thinking about the inflationary effects of the tariffs. They push it down when they think about the economic slowdown and the consequent need not to raise interest rates. But the other thing, another couple of things that are arising is that some people are now questioning what's called their asset allocation into the US and their treasury and into the Treasury bond yields, because normally in times of either economic or geopolitical or political uncertainty, markets revert to what's called risk aversion trading. And one of the recipients for that is the US 10-year bond market, the US bond market, because bonds are seen as safer than equities. But especially during that tariff announcement, investors were questioning both in equities as well. I know it's reversed with equities now, they're high again, but whether the US should, still seen as the primary safe haven destination, but it was, should they actually be reducing their asset allocation and their allocation to US assets just because of the problems that were actually occurring there. And ironically, when US bond yields are going up, German bond, they call it the bond, their bond yields are going down. The other thing that the markets are starting to question is actually the level of US debt. And it's 36 trillion at the moment, and it's going to go up significantly. The headline number is probably secondary to how it compares to the debt to GDP ratio, and the US is about 110%. Now, to put it into perspective, New Zealand's about 47%. Japan, though, is about 220%, but Japan has very high private sector savings, which offset that.
It's all internal.
And we have very high private sector debt too because of our preoccupation with housing finance. So just look, as I say, that's just a little bit of an update. As far as New Zealand goes, we actually haven't had much happen since the last report. When the OCR was dropped to 325, the market, there's another OCR review tomorrow that's only factoring in a 12%, only assigning a 12% probability that it will drop to 3 tomorrow. And it's not till October or November that they're expecting it to go to 3. Now that's where it gets interesting, because both the RBNZ and the markets, their current pricing and assigns probabilities. I think the market pricing is about 8, it's 13. It's about a 56% chance or a 62% chance that the markets, that the OCR will be dropped to 2.75%. So 3%, yes, that's more or less baked in, but 2.75%, it's sort of 50-50 whether or not that will actually, whether or not it will decline to that. So, and New Zealand swap rates have actually gone up, and that's as a result of US bond rates, as a result of US bond rates going as well. So that's the quick, I mean, I can spend the rest of the day talking about what's happened in the markets and the economy. And Stuart, I just checked on your, what you're saying this morning, and there've been more tariffs announced overnight. That's between 25 and 40%, Japan and Korea 25%. So that's the economic outlook or current situation. Are there any questions on that?
Any questions around the table? No?
No. Oh, one question I do get asked quite a bit when I present to these meetings is that, I talk about the US debt number, and people ask me, and there's 36 trillion. And
37.
37 now. Oh, well, if you've seen the US debt, you've seen the US debt plot. Well, I timed it actually, and it goes up $1 million every 30 seconds. The US debt. Their interest costs are now expected to exceed that of US defence spending, which is 900.
20% of government expenditure is going to be servicing interest.
Yeah. Oh no, I won't cover that one. So as far as the report goes, look, the only thing that the only matter, or the one to note on the liquidity, funding and policy compliance page is that you were just below the liquidity ratio of 108.93%. That sort of translates. It's the LGFA's way of putting it. It should be. I think it should be above 110% or 10. Really, 10%. It's a better way of putting it. I think that 10% above your debt level. You were slightly below that, but we've taken steps to mitigate that, and you've increased the amount of the BNZ facility because we want to be policy compliant at the end of June. That's when the LGFA really looked at that covenant. So that will be rectified prior to it's Catherine, you were just saying it's been rectified now. Cost of funds is 4.08%, with excluding the HIF, or 4.03% with the HIF. Your cost of funds is projected to fall slightly, but not too much more. So we've come from 5% or 5.1% over the last year or so, but it is expected. Well, it's actually it's more or less going to stay around about 4% because we're coming to the end of the easing cycle. Maybe one more cut, possibly two, and what we have done as a result of that is that, and that is mentioned on the slide, which details we took out $100 million of interest rate swaps at rates between 3.45 and 3.76%. Now, I think that gives you a reason. So it's 100 million swaps. It's still quite a bit for you to do.
Yes.
But we just identified that the time was right. We've been holding off doing that quantum of swaps, but it has lifted your fixed rate cover. But we think the note is one of the points to note is that you still have a reasonable exposure to floating rates. Now the floating rate will go down to, or maybe it's at 3.29%, I think at the moment, the 90-day rate. It may go down if the OCR drops, but I don't think it'll go much more. No. But it will stay more or less where it is. So for a while, and then it'll start going up. So that just gives you an added level of protection. But yes, you probably have reached the low as far as your cost of funds goes, but we mitigate as much as we can. Now, I did mention two strategies here, which we will need to implement by the end of October, because because of time erosion, cover that's in the longer dated 4 to 10 year time bucket will slip back to 2 to 4 year time bucket. So we'll have to require additional hedging. And this is the question I've got here, and I'll be interested in your comments on it, is that we can do it one of two ways, or we can have a mixture of two. If you take out swaps now, and those are the ones on the left-hand side, I'm not sure what page, our page 5, but I'm not sure what page your one is.
44.
Yeah, 44, yes.
If you do the one, you can see the graph there on the left-hand side there. If we do 40 million of each, then those and that starts now. Now, if we did those, the rates are 3.66 and 3.77% for May 30 and May 31 maturities. Now, the 90-day rates, so about 4.29. So you would be swapping a floating rate of 4.29 for those. These are starting on 15 July, so this month, 3.66, 3.77. So there's immediate pay away. But because of what we call the shape of the yield curve, and it's now positive sloping, we used to have an inverted yield curve for the last 2 years, which is, we've only had an inverted yield curve twice in the last 25 years. And it's symptomatic of the fact that you're either going to recession, interest rates are going to fall. And that's exactly what happened. And we took advantage of it. But you get lower swap rates than you do the 90-day rate. But now that it's what we call positive sloping, which is totally normal, you get higher swap rates than the floating rate. And that's what's happening here. But if we had the same maturities, but we didn't start the swaps till October 27 and November 28, the rates is 3.96 and 4.25. Sorry, 25. So those rates are considerably higher. Yes, but the thing is that doesn't kick in until 27 and 28. And you would retain your exposure to floating, which means that you would get the benefit of the lower floating rate. So the question I've got for you is, would you, and it simply comes down to a case of the maths on it is exactly the same at the end of the day, but it's where the benefit and the cost occurs.
Falls, yeah.
So if you wanted the cost now, but the benefit later, you do the one starting in July now, so the ones on the left-hand side. If you want the benefit now, but the cost later, in those later years, starting in 27 and 28, you do those ones because you retain your exposure to floating. So that's benefit now, cost later, compared to the cost now, benefit later. So I'd just be interested in what your thoughts are on it.
Well, putting it back on you, if it was your money, what would you do?
It's not actually a financial market decision. It's actually putting it back on you. It's not a.
I agree, Mr. Chairman, I'd like maybe hear from Catherine or Paddy on this.
Yes.
How this, looking at our
Profile.
long-term plan and where our debt level's going, goes high and then comes down. So we'd be, from my point of view, we'd be able to take the benefit now rather than later. But that's just based on what I appreciate some advice from Catherine or Paddy.
It comes down to a cash flow. I mean, as I say, I'm not trying to duck the question here. It comes down to cash flow. Would you rather have the cash flow benefit now, or would you rather have it later on?
Rather than interest rate or cost of. So it's just cash flow, not so much the cost of the debt. We're talking in the short.
Well, both. It's the cost of the debt which flows through to the cash flow. So do you want the cash flow benefit now, or do you want it later?
Yeah, I think what we'll do, just it's obviously a question that's come out now, so we'll seek to get some more information from our Miles. But noting that this is on October, we've got another opportunity in September to bring back the committee to flesh out a bit more. We've got the cash flow sort of benefit, but we want to know the certainty as well as what we want to play out with the trade-offs.
That's fair, and I mean, I think I would just add, perhaps it would be interesting for the committee to think about once we're further down the track, what, if any, impact regional deals might have. I'm just at a very high level, the potentiality of there being an alternate means of funding for this council could be an interesting factor, but that would be years away, effectively, potentially. We don't know.
And probably then with a bit more certainty with the CCO or with the water.
Right. So, sorry.
So just around it, say we can push this out to September. If we want to be doing these July swaps, though, we need to sort of do those now.
We can push that start date out, so that doesn't matter. The only thing is, if for some reason, you know, if we did get some sort of geopolitical upheaval and interest rates came down, we had to do something by October. If in the meantime that happened and before September, I mean, I think management have actually got the discretion.
They've got it delegated.
So, yeah, I mean, if the opportunity arose, then I mean, I would be talking to you pretty quickly about doing it. So, and I'm having a meeting with Catherine and Patty this afternoon anyway.
Bill, any?
Yeah, I guess if we had to make a decision today, I'd take the cost up front and get a bit of later.
Yes, yes.
As you say, change is certain. So yes, to potentially take the upside now and wait to see what happens.
Okay. Okay. There's some feedback. Okay, well, thank you, Claire.
Thank you.
Right, I'm happy to move the contents of the report. Seconder, Lisa. All those in favour? Thank you. Thank you, Miles.
Thank you.
Yeah. So we've got Andrew at the top. Is it Andrew?
It's on.
Through you,
Yes.
yeah, we just need to set aside standing orders.
Yes.
To invite the QIC to the table.
Yes.
But as you can see, we've got with us Todd Grace, who is acting chief executive.
Yes.
At the moment, I understand.
Not today.
Not today. Okay.
Sorry, Todd can't make it.
Oh, sorry. And Simon Flood, chairman of QIC.
Yes, so who have we got?
We got Simon Blood and Andrew Williams.
Sorry, Andrew.
Oh, I've got Andrew, yes, so you were down originally. Yeah.
Yep.
Yeah.
That's where we got.
And he's here.
Here in person.
Mhm.
So if you're happy to
Yes.
move to set aside standing
I'll
orders.
move. Yep.
All those in favour?
Yep.
I'll second that.
Yeah. Thank you. All those in
Please
favour?
join us.
Come forward. Sorry, the hold up, please.
It's fine, actually, I used the time to pay my annual dog license downstairs, so it's,
Fine,
it's all good, we're sort of multitasking.
very good.
So it's really great to see this is the first time that we've had QIC here reporting on this new framework. And I'm sure that we're just happy for you to step us through it, take the paper as read, and perhaps just highlight anything you'd like to highlight, and then there may or may not be some questions.
Well, look, just before we kick off, yeah, as part of our commitment in the SOI, we wanted to be as transparent as we possibly can be with our majority shareholder and all our stakeholders in terms of, you know, the progression of business. But obviously, what we're entering into is probably the biggest capital plan since the airport was originally built, you know, circa 90 years ago. So it is significant, and we want to make sure that you know, all the stakeholders, particularly our majority shareholders, has the opportunity to ask any questions that they want to ask, and particularly to do it in this public forum. So thank you for that opportunity. Thank you for having us. I'm going to pass the talking stick to Andrew. But if there are any questions, we're very happy to take them from you.
Thank you.
So just we'll take the paper as read, but from the call outs from my perspective, and the CFO of Queenstown Airport is it's quite a long, another reminder for it's quite a long capital program. Which had a number of off-ramps as we sort of work through, and what's embedded in the numbers, to give you a sense, is the large majority of the capital program of circa 500 million actually relates to the terminal. And we haven't kicked off on any of the significant terminal works yet. So as the risk embedded, financial risk is not present yet, but as we clearly kick off in due course, that risk becomes more heightened for obvious reasons. Probably draw your attention to the credit rating. So I've had a piece of work done by PwC or helping us with our funding strategy. So it takes us to a point where we're within investment grade, which is incredibly important for us. That's also played well in recent discussions with the funding community. So we've had engagement with 10 New Zealand domiciled banks over the last month with incredibly good support. In those discussions, there's high demand for funding infrastructure assets in New Zealand. So when we look to go to market, which we're envisaging late this calendar year, we think we're in really good stead to extract good value from the banking market at that time. So, and a bit more meat on the bones of that comment is that'll be a refinancing opportunity for us. So we'll go with an opportunity to look for funding in what's likely to be 2 stages to ensure we don't carry a lot of debt that we're not utilising and therefore paying excess for loan fees. So it's probably the call out. Probably the other element that's not embedded, we've just concluded aeronautical pricing consultation with the airlines. And you'll be aware that the underlying business model that supports this level of debt and profile is actually predicated on the ability for our airline partners to pay. So we had some very good outcomes, I think, around the aeronautical pricing consultation, and got some very good feedback relative to the way other airports in the country go around aeronautical pricing consultation. So our pricing is in play from 1 July 2025 to 30 June 2028. We're particularly focused on that period, in particular because the terminal assets come on in the next pricing round beyond 30 June 2028. So what that does is gives us an absolute degree of confidence around the capital program over the next 3 years.
So no repercussions on what happened in Auckland with their, no.
Not at this stage. Now we're incredibly conscious, Stuart, that as we move forward, you know, the heightened obligation to consult on the larger part of the development program, the terminal, which carries that heightened degree of risk around integration with day-to-day operations. So we'll kick off in that engagement with the airlines again, not for aeronautical pricing, but in engagement around the size and scale and fit for purpose of the terminal asset. That'll kick off in earnest, probably in the second half of FY26, the year we're just in. So,
and I think it's fair to say that, and you have read a lot about it in the paper. There's a very delicate balance that exists between airlines and airports. Yeah, and they need to exist in a sort of a symbiotic relationship, and we certainly take the perspective that we are in a partnership with the airlines. And so we, Andrew, you and Todd were in Australia, what, a couple of weeks ago, sitting down with Virgin and Qantas. I'm not sure, Stuart, what you're referring to in terms of you know our minority shareholders' engagement, but the boys at QAC, whether it was Glenn, whether it was Todd, whether it's Andrew, we have worked in a very transparent manner with the airline partners, because we basically want them to be happy with what we are doing at the airport. We want their passengers to be happy, because we see Queenstown Airport is sometimes the first impression that a foreign visitor has to New Zealand, you know, not just Queenstown, and also sometimes the last impression that they have before they leave. So keeping those, you know, our partners very happy, and then obviously you know, oiling the wheels of domestic travel. We need to have a first-class piece of infrastructure out there, and they get that. So it's often what you get in these situations is that we are asking people to spend money, yeah? And if you sort of think about that on a personal basis, you need to be convinced that, you know, you want to spend the money. And so we engage this in a very, very transparent manner and in a very personable manner. So we will go and visit our airline partners. We will do our best to answer their questions. And basically what we want to do is we want to put a plan in place that everybody signs up to. And that's what I think, and Andrew and Todd have done a really good job this round, and we do it on a regular basis. But that is the objective, is to get alignment in terms of the deliverables.
Yeah, my comment wasn't about the shareholding; it was about the pushback on them.
No, I know what you're referring to. Yeah,
I had 20 years in Lean Airport, which I did for many years.
Right,
I'm familiar with it. Yeah.
So I think one thing that's been really pleasing is we have received good feedback.
Yes.
We are trying to do engagement our way, which is a personal, we front up and visible leadership way, and we're conscious that the airlines are paying the bills, the majority of the bills, and it's important we respect
The customer's paying the bill ultimately.
So the only other thing, Ron,
the element, probably the last page of the report, the debt profile, as it ends from a graphical perspective in 133, it's important we don't draw a linear line through that. That really is the peak. That's the peak debt.
Yes.
So if we were to extend that time frame, we'd have a debt profile that actually decreases quite
After that point.
quite rapidly
Yes,
after
comes
that
off.
after that point.
Yes.
So it really reflects that's building effectively at the end of the terminal infrastructure development, and then no significant capital expenditure committed after that time.
I had a good session going back probably a year or two ago with Glenn and with your chair at that stage.
Okay,
Yes, so we engaged through this process. So
hopefully this is consistent. It's good.
an update now. Yeah, that's right. So I'll open up to Lisa.
Thank you, through the chair. I'm curious about what you hear in global tourism trends, if there's any risks of slowdowns or anything like that. Just understanding that our risks are obviously construction escalation or slowdown of tourism and some volatility out there. Any reflection or things you're hearing?
The targets put in the SOI are a reflection of what we're seeing in terms of the airline schedules going forward. So we are not hearing anything negative. The biggest challenge that we probably have at the moment in New Zealand is the Air New Zealand's fleet. And they have said, and you've seen recently that they're going to be adding another 36,000 seats going into the latter part of this year. About 19,000 of those will end up coming to Queenstown Airport, which is good. It's mainly on the Auckland route. So we are not hearing anything from our partners or seeing anything from Northern Hemisphere trends that would lead us to think that there is there's going to be a downturn, if that's what you're asking about.
So you're still seeing confidence in our airline partners around committing to new aircraft and increasing those routes? And
Richard, you had to comment on Richard attending the board meeting, CFO at Auckland Airport. In New Zealand.
In New Zealand. Yeah, I mean, look, we had the CFO and Richard Thompson and head of airports Kate O'Brien who come and sit down at our last board meeting, and effectively the thing that is around there is that Air New Zealand's our biggest partner. Yeah. And we work very closely with them to ensure that we are able to deliver infrastructure they need, but also they're working hand in glove with us. I think they remain confident, but the issue around fleet is challenging, and not just for Air New Zealand. It's challenging for all airlines around the world, and that links right back to COVID, the ability to source parts. The war in the Ukraine has also had an impact because there's a lot of metals that come out of Ukraine, obviously not coming out at the moment. And then there's the order backlogs, which you're seeing, particularly at Boeing and at Airbus, which is just slowing the whole chain of fleet renewal. And so I think what Richard, the message that was coming across is that they are working extremely hard to manage their schedule, but there are factors outside of their control. But in terms of their enthusiasm for Queenstown, you can see by what they announced just a month ago that they remain very, very enthusiastic and wanting to serve the Queenstown market.
thanks.
At a tactical level, just one other bit of flavour is we also consult, part of our pricing consultation, we consult on passenger forecasts for a period of time. So what was being presented in the SOI reflects effectively reflection of the engagement with council. So is acknowledgement, Simon's comment, really good, strong demand.
Come from their level of confidence and.
It does, and schedules as well.
Yeah. Thank you. Thanks.
Thank you. So this is my first Audit Finance and Risk Committee meeting, so I'll ask a question. It may have been covered in the past, I'm not sure. But the first one is just a clarification. The table you've got on the third page of your report for the forecast annual dividend paid. It's got 2 columns of figures either side of it, which are different. What are each of those relating to?
Left-hand column is annual,
Okay.
right-hand column is cumulative.
Right. Okay, very good, thanks. And then the other question was on the last page, forecast debt. I keep coming back to, obviously, you've got some big transactions coming up, and I've mentioned this before, so pardon me for mentioning it again, but the Companies Act, has a reference to major transactions and the where that then puts you after the transaction in terms of the asset value of the company before the transaction. Is there anywhere that is easy to cross-reference, with this forecast debt, what the asset value is at each of those steps? Just so that's relatively easy to see.
Yeah, sure. So just a couple of things on that. It's, I think section 129 of the Companies Act that talks about the impact of major transactions, relative to the asset value of the company. That doesn't apply, in this case. And the reason it doesn't apply in this case is because we have a number of stage-gated transactions. So it's very much stepped through. So it's a step program of delivery. It's not a single transaction.
It's not a fait accompli.
No,
Exactly.
no.
So the purpose of the that section of the Act is to make sure that management and boards don't run amok and go out and sort of bet the farm on, one single transaction that, relative to, and I think is it 50%? I think it's 50% of the NAV of the company. So that's the purpose of the Act. It's also to make sure that shareholders are protected from management and boards doing things where there is not sufficient disclosure, transparency, communication. Yeah. So in terms of what we're doing, there has been extensive engagement, communication and transparency on what we're doing. And the quantum of money that we are spending is going through a stage-gated process. So you have to do stage A before you're allowed to progress to B, before you're allowed to progress to C.
Yeah.
And in terms of the valuation of our assets, we do a formal valuation every 3 years, whether or not it is, sort of, action or required. We do a desktop valuation every year, and if that desktop valuation indicates there's been a 10% move or more in the asset value,
Then you go to a full.
we then go to a full valuation. So we could, in rising, asset, times, we could be doing a full valuation every year.
And I think the other flavour that sometimes we do an enterprise value, so that's a valuation of land and buildings. Then it's a 3-yearly process to value that business.
So when you say it doesn't apply in this case, would it still apply, but the way that you've structured the program, you'll be within those limits, but it would still apply though, wouldn't it?
No,
Because
well,
you're
section one,
skipping up, the asset value is increasing each time you go for a new, for the next stage of the development. So you'll be complying with that clause, but are you happy to say that it doesn't actually apply at all to this?
well, if we
program?
went out and say we were going to go and buy an asset, and that's what, these transactions typically,
Or sell an asset.
or sell an asset that was worth 50%
Or more.
than our assets.
Yeah.
Then that would trigger it automatically.
Yeah.
So, so never say never,
Yeah.
but that's not what we're doing. We're doing a stage-gated process where overall we will spend in the vicinity of $500 million, which against our EV, which is what, 580, something like that, 550. It would trigger it if we were doing it in one hit,
Yeah.
but that's not what we're doing.
No. No, I understand that, because we have talked about it before, so it's just, I guess, being clear to council and the committee that that's what's happening, I suppose. And whether there's any value in having, you know, a relevant asset value chart that goes with that forecast debt chart, so that it's
We
clear,
can stick that in, no problem.
just for ease of reference.
Yeah, sure. We can, no problem.
And revenue projections would be helpful as well.
That's what I was going to make, Mr. Chair, or other finance report, we have a debt to revenue limit,
Yeah.
and that would be nice to see that. It's just give us comfort that you're.
Yeah, no, it's great. So we've got our banking covenants around, you know, debt to EBITDA, interest cover and those sorts of things, which we can make it from. Probably just in the nature of reflecting on the question. I can't remember not sure what page is in your papers, but there's the one with dividends at the bottom and then there's a table on the top.
Yeah.
Probably to specifically answer your question around what are we committing to now? What is kicking off at a financial perspective in FY26? What sort of focus on the table at the top of those level of significant projects and the value of them that we're looking to kick off in earnest at a financial commitment level? No other significant projects have been committed to from a financial perspective. We've got a commitment from a direction of travel, but around committing funds to those projects, we've not committed funds to those projects at this time.
Right. And all those figures will be well within that 50%.
Oh, well, and half of it, well within, and yeah, well.
110 million there.
So what I can do for the future is actually make a positive comment in that regard.
Thank you.
Okay.
Oh, it's a couple of technical ones. What's AGL purchase? AGL,
Airfield ground lighting,
okay, and RPU? Replacements,
Residual power units.
okay.
Hopefully I've got that right. Yes, but technical friends won't have a challenge.
Jargon.
Yeah.
That's right.
Yeah, power units on the roof for
so the lighting, basically Airways pulled out of lighting throughout the country and they sold their lighting, whether it's Auckland Airport, Leeds Airport, Wellington, Queenstown, et cetera. And we concluded that negotiation 30 June.
And one last one is the working with the general aviation for the shift to the northern side of the runway, working all right? Progressing okay?
yes, early doors, but yes. Okay, that engagement's strong.
Thank you.
Heath.
Good question, thanks, Mr. Chair. I think the Pearl Jam concert, for almost every rock enjoying southerner to town, and good news that they want to use Queenstown Airport, not the Coca-Cola meeting. But I'm just saying here, is there any upgrades to parking in the program? And apologies if I haven't cross-referenced this to the SOI probably, but what category would that fall into if it's in there?
The work that we've done through the development plan and therefore reflected in the capital program is no need for an increase in the numbers of parks, acknowledging we've got capacity left in the off-site park and ride facility as well. But as we look forward, mode shift and the likes, the view, there's no additional parks required or parking capacity required.
And obviously through the work that's been done, that there hasn't been followed as a constraint to achieve these things.
We are conscious that we have land holdings that we could develop into car parks if the need arises down the track, but no need at this stage.
And I think it's fair to say that having reopened Park and Ride, we are seeing more people beginning to use that. So Park and Ride, we could arguably expand Park and Ride, just given where the real estate sits. And we've also done car park B.
For resealing, not capacity.
We've done reseal. We've resealed that, which was out for a while.
Okay, that's cool. Thank you.
Yeah, Bill. Thanks for the report. That's really useful. This is the first time we've received it, so I'll probably ask questions.
Please.
I guess as an agent of the shareholder would probably look at three different aspects to this. One's value, one's EBITDA, one's resilience. And I think questions been asked around what additional information can be provided, and I think actually seeing that the investments will actually increase the value of the company is really important. So providing, I guess, a table, Andrew, that shows net asset value as we speak would be really useful. And within that, and this is probably maybe for a subsequent meeting, just how this project is going to be governed.
I know the mechanics with the gate, the different things and things. But is this the function of the audit committee or QAC, or have you got a separate committee?
So we're just to take that right now, we've been talking to Auckland Airport about how they have overseen and governed their master plan rollout. And we are in the very early stages of establishing a board governance committee, which will be specifically focused on this project.
Yep. And on the management side, obviously huge commitment. So what's the capability to deliver on that? Are you building an office, a unit to actually oversee and manage?
Yeah. So what we're doing at the moment, though, is that you'll appreciate we're in transition between Glen and Shane. And what we're doing is we are working to identify the roles that we will need. We've already made some investment in procurement, but then we'll need to look at project management. And so we're moving as fast as we can to look at exactly what we're going to need and then how we're going to staff it. But if you were to ask me a direct question, are we capable of executing in the heart of the program right now? No, we're not, which is why we have stage gated the way we have stage gated. The projects that we've done, if you look at EMAS, which was originally budgeted at about 23 million, which we delivered under budget and on time. We have been building expertise internally, but will we need to bring on additional resource? Yes, we will, and we're in the process of looking at that. Yep.
Maybe another flavour on Simon's got, but I'd almost separate the program into two elements. One is terminal, and supporting Simon's comment, that's where we need the increased expertise to come into the business because of the complexity and integration with operations relative to other parts of the program, the likes of parallel taxiways, which can be quarantined, fenced off and built during the day. They don't have a significant independency with day-to-day operations. So we've got the skill sets to do those less complex, but in terms of terminal, absolutely need to boost the expertise in that building organisation.
In terms of second bit, which is EBITDA, it's good to have the forecasting dividend. And this is just my naivety. So debt goes from 50 million to 350 million. It tops out at 350. So as we build it incrementally, sequentially, so depreciation cost is going to go up. As you borrow, interest rate is going to go up. None of these things have been contracted because we're going to do it in stages. So how confident are you that, given all those different things, you can generate the dividends? And I guess it goes to some of, I think I was asking a question around, it's almost like a 3 or 4 line table, row table showing expenditure projections as it's changing with the project to give a sense that you can generate the underlying dividend for our long-term planning purposes.
Good question. And we'll, in terms of feedback, we'll pack it on and for the next update, we'll do that. I'll just leave you with just pick up on Stuart's comment around aeronautical pricing. So one of the benefits of the nature of the business that we're in and the fact that we have a regulated pricing regime and we follow ComCom's approach to pricing is whenever we set pricing, as we've just done, it takes into account forward interest rates, takes into account forward demand, and it takes into account implied in that a weighted average cost of capital. So the revenue is assessed in each of those pricing periods, and what we do from a governance perspective is ensure our capital program has strong alignment to the aeronautical pricing consultation with the airlines. So, let's, for example, interest rates, which are embedded into the weighted average cost of capital. Based on that committed direction of travel, we would look to implement an interest rate strategy about forward hedging, and the forward hedges should be very closely correlated to the interest components embedded in the weighted average cost of capital calculation. So a big component of our forward revenue will always be underpinned, notwithstanding significant matters, black swan type events, that will always be underpinned by strong, demand from airlines through consultation, and therefore our funding strategies and the likes to sit on the back of that through risk management.
I think it's worth acknowledging that your dividend, you've exceeded the forecast dividend for the last 2 years.
Yep. Maybe the other reference to, which I don't want to gloss over, we're coming off a very, very low debt level. So whilst it grows quickly, I think our traditional basis for measuring debt relative to the organisational size, we've got a debt level which effectively is a 10%, reflects a 10% gearing level, which is incredibly low starting point for us. If we were starting at a much higher point, 30 or 40%, then these numbers start to build quite quickly over time and to potential periods of challenge. But given we're starting off a very, very low base in relative terms, debt levels of, I think at the end of the year, we finish at around 50 million relative to an enterprise value of 550 million.
So I think from a value EBITDA, just having some core ratios in there.
Yeah,
as well. Yes, yeah.
No, that's a good.
Probably the third thing a shareholder look at is resilience. Make a huge investment. You don't want to get to 230 before buying that. We need to spend another 100 million because we didn't actually factor in risks and change and everything else. So in terms of the plan, obviously just spent a lot of money with the runoff from the
units.
Yeah. And we're obviously modernising passenger services, cargo handling, that sort of thing. Yeah. What sort of contingency is here for anything relating to airfield and landslides and related matters? Do you think you'll cap it off that you won't be bitten by anything in the next 10 years? And that, in effect, what you're investing in is going to look through to probably 240, 250?
Yeah, so the process will work through master planning, through the development planning and support through Oricon as an independent partner has supported this direction of travel. So part of the scale of the investment is effectively a backlog of investment we need to get up to speed for the level of volume we have today. We're also very conscious of the level of investment acknowledges our primary constraint, and that's the noise boundaries. Yeah. So this gets us to the point which we know that there is that constraint that exists today. So we believe on the back of those things in terms of noise boundaries, capacity, backlog of investment, that level of investment is appropriate and should see us in good stead. If things change beyond sort of 2030, 2035, then it will require a consideration whether there's any additional investment to be made. But the assessment is based on all of those factors. It's the appropriate for the purpose.
And I think the other point just to add on that, Bill, is that you will know that Queenstown Airport is a designated lifeline utility. And that means that you'll see it coming through and the company, we've got it by a line item. But we've spent quite a lot of money in the last few years on seismic strengthening, just basically to make sure that, in the event of a natural disaster, particularly an earthquake, the airport will remain safe, still functioning and operable. Yeah. And so we are guided by that as well.
Thank you, Bill. You'll move? Yeah, no further questions? Sorry, you've got to move in? Yeah, thank you, Heath. All those in favour? Okay, thank you.
Thank you very much.
Thank you.
Through the chair, you move to. Yeah, so you need to specify which standing order, and I suggest it would be 13.6, the member's right to speak. But yeah, you're obviously doing to reinstate.
Thank you. Yep. Okay, health and safety. We've got Ellen. Yes.
Through the chair,
I'd like to highlight 3 key points from the reporting period.
Thank you.
First, there was excellent engagement in our wellbeing initiatives, including the Aotearoa Bike Challenge. QLDC was first in our category. Also, there was lots of positive feedback on mental health briefings, which were held both for people leaders and for officers as well. Second, there was 1 contractor notifiable event, which WorkSafe chose not to investigate. And third, there was exceptional uptake for our health promotion initiatives. We had 134 employees take part in Healthy Heart sessions, where they check blood pressure and also your body mass index and give some advice on diet and related matters. And secondly, there were 214 staff who received flu vaccinations provided at a QLDC venue, which I estimate to be roughly 1/3 of our officers.
That's a good update. Yeah.
Exceptional. So with that, happy to take any questions.
Open up the question. Yes.
Sorry, looking around, not wanting to hold the floor as usual. That's great about the flu vaccine update. I'd be interested in some tracking afterwards as well to see whether our, just because we ran a similar activity in an earlier organisation I worked with, and we were able to see real significant reduction in time off with those sort of correlations. So just a curiosity point. I'd also like to commend you guys, excuse my language, guys is a very familiar term in my family, so commend you on the guidelines around managing and reasonable conduct that are included in our papers here. And I've probably got a question around, it's on page 75, and that's page 16 to 18 of the report, talking about social networking sites. And just acknowledging the increase in what the exposure of civil servants is towards unreasonable conduct. My question is, what are we doing around keeping staff safe? I see in that social networking site column, we can do quite a bit around our own sites, around limiting comments or things like that. What actions do we take when it's not our site, when we're seeing unreasonable conduct and comments on other social networking sites? And I suppose, you know, I have personal experience in this area. I know, for example, we have one prolific commentator who has a criminal record in digital harassment, and yet is still not moderated on some social platforms. What kind of action are we able to give our people and support around that kind of unmoderated conduct?
I might take this one. It's a difficult question to answer entirely in this setting. But I think we're highly overtly aware of that issue. And certainly staff who are needing to deal with some of that direct contact, such as comm staff, we're very mindful of ensuring that their well-being is intact, and we actively, I guess, engage with those staff on their well-being. Look, I think it's a difficult one. To what extent do you actually let that into your life? I mean, we can't actually manage staff who want to access material in their own time on their own devices. But at work, we do recommend that if it is not something that you need or are required to do for work purposes, then simply don't access. You can make that choice yourself. And that's really the most we can do. If staff want to actually take a deep dive into some of this material, we know, not just anecdotally, we know that staff have become very distressed by material that they have read online, and we are continuing to work in that space. that's probably the most we can say.
And I suppose it's because I'm aware of recent case law where advising people just not to read it or not to engage with it is actually not seen to be enough proactive care.
That's correct. Actually, we have, can say one further thing, Lisa. You know, it's an active conversation we are having with our senior counsel actually currently.
Right. Yeah, because I suppose I would like to see encouragement around evidence gathering and you know, the only thing that we can combat some of this with is factual response. And yeah, I suppose I just want to offer my care and consideration to those individuals that are experiencing the distortion of comments, because it's very easy for people to draw lines between information that may not be accurate. Yeah. So and I'm really pleased to see that within our own environment, we've been really proactive around that. Just acknowledging that we may have other pathways under the Digital Harms Act, and you know, and personally, police advice I've received around creating those evidence-based documents, because I think some of the individuals in particular, we're only dealing with a very small group of individuals when you look at the protagonists, and indeed some very clear criminal backgrounds in this space. I think we need to take a very clear stand where we can to ensure health and safety around this area. So,
thank you.
Yeah,
thank you.
Thank you.
I also had a quick question about the managing unreasonable behaviour, but at the different end of the spectrum, where you know, sometimes that kind of behaviour might be triggered by someone who feels like they haven't been heard, or their issue isn't being taken seriously or taken to the right people. Is there any, and there are some references to that in the document, but what are the steps that are involved, you know, as well as managing the behaviour, but is there a, you know, a background review of the specific instance that might be causing someone to behave in that way, to review what, you know, what their issue is and whether there is some way of dealing with it, rather than, you know, people might feel like they're being fobbed off or that it's not being attended to.
I don't think fobbing off is our culture
Okay,
at
just
all.
my-
No, I know what you're saying. And I think, you know, we're certainly investing in, you know, we're currently investing in an organisational wide customer service review. So we're not just resting on our laurels, you know, do we always get it right? But what I see and what I hear from our customer engagement, which is happening as we speak, you can listen to it live if you just hang around in our lobby downstairs, for example, is staff who are doing their utmost to try and assist at times. And actually we experienced this yesterday. No effort to assist or try and appease concern prevents someone from becoming highly agitated and aggressive towards staff, and that is occurring on a regular basis. So that can be triggered by something very simple, like a parking ticket. But for some people in our community, that can be the straw that breaks the camel's back, and it's really tough. We as a staff have a lot of sympathy for that. We talk about mental health challenges in our community. We don't see people being aggressive just for the sake of it. We know there are triggers behind that, and it's really important for staff to understand that too, and I think elected members, because it is important that you know, we don't see this as a personal attack, that there's actually something in behind that has become just too much for people in our community to cope with. So I think you've got to see the whole picture, and that's certainly our approach in terms of our staff training. But I'm really pleased to say that yesterday's incident was handled incredibly professionally. It went just as we had outlined in our policy. Staff were really well looked after, and we have trespassed an individual that has been communicated across the organisation really well, so the whole thing was well managed. We don't want to be in this situation, but we need to be prepared.
The other comment I was going to make too is along the lines of what Lisa was saying, is that there are small people that might make the comments online, but there's a much bigger group that read them. And sometimes those comments can stoke the fires. And if they do have an incident, they need to come and speak to the council about it. It's already started them off in a position where they're down the line of being aggrieved.
Correct.
So yeah, if there's any way to moderate what is being said online.
Often, I mean, the difficult thing is all of our comms staff will attest is if we do try and moderate something, it is often trolled and attacked, and you kind of, sometimes you just can't win. But the strongest thing that we experience is when the community actually self-regulates. So when somebody pipes up and says, actually, that's not fair, or that's not right, or that's not my experience, that actually gets a lot more traction in a positive way than anything we can do to counter.
Thank you. Any other comments, Bill? Oh, sorry, you go, Bill.
Just following on, so these guidelines and all we're talking about here, it says right at the beginning, it's just basically employees, so elected members, we've got to look after ourselves separately. And understand what the local government, local government New Zealand, they're talking about an allowance for people to get.
Taitora, I'm talking about some security.
Yeah. Okay, I just want to make that, so, but a lot of this is applicable for elected members.
Absolutely. And that's a really good point, Lyle, and we are going to look at that in the induction for the next training.
Okay.
I think it's an important subject.
Cover off.
And a couple of quick technical ones. The first aid course, is that the full first aid course? Stuff?
Through the chair, that's taken correct the full one.
Okay, and what's the child protection? So you mentioned child protection, something.
So the child protection, for example, would apply.
Child protection training.
Yeah. So we've got a child protection policy. So that applies, for example, we've got pools and we have children's swimming lessons. So,
okay.
So we actually need to have child protection.
Yeah. Obviously, yeah. Thanks.
And Bill, in terms of the contractor, the bid with the truck and power line, obviously it's very serious. Fortunately, nobody was seriously injured or died. In terms of the lessons and learnings and the new safety measures, are they going out to all contractors who are in these sorts of situations, or just this particular contractor? And do you workshop with contractors across the board around safety issues and use examples of events? I was at a WorkSafe workshop in Auckland about 3 weeks ago with all major construction firms and infrastructure builders. And physically, what surprised me was they all get together every month for lots of war stories and what. So how are we managing it here? Because it seems to be one of QLDC's biggest risks. Contractors and subcontractors trying to get stuff done too quickly, not paying attention to proper process.
So the Fulton actually did have everything in place. They just didn't do it on this side. So it's not, they haven't really come up with, you know, they haven't reinvented the wheel, if you will. What they've done, we met with Aka Westrup and Anna Sinclair, and we had a chat from our movement, because we had been at the site a couple of days before for inspection, and everything seemed okay, and then a day or two later we had this sort of, you know, no minimum approach distances in place, and there's kind of what's happened. They put everything in place, but then the stockpiles just got bigger and bigger, and all the good stuff they did at the beginning, they carried on with on site, but the stockpile's just over there, so they stopped monitoring it and things like that. So what they're doing there is putting more stuff into place for their own, you know, we need to keep up with the toolbox talks, and no, let's not get them in place, and when things expand, let's go and review them and things. One of the things that our project for this next year, we are creating a video for contractor inductions and things like that. And we do, when we have incidents like this and we talk to the contractor, they produce a safety alert, we will send it out to all our contractors and, put it on our Yoga website and which is internal, but it's there for project managers. As they're bringing people on board that, well, that's actually not that one to sort of remind people about, I'll just send this out as well. But we don't have there is a forum for contractors with the project managers and things, but when we have this sort of thing, it's more of, I want to talk to them, our project managers are welcome to come along and often do. But we sort of talk to the health and safety people and say, hey, look, this could have been done a bit better. What are we going to do about it? And, how do you put it? Get some sort of formal recognition. So they have a safety for life handbook, which they've updated and send us copies of the updates because of this incident and things. So, yeah.
Thank you, Bill. Any other questions? If not, Lisa, you all move. Thank you. Gavin, maybe the second. Okay, all those in favour? Keep up the good work.
Thank you.
Thank you. Right, we've got Bill.
It's an apology, so.
Okay.
No.
So we've got Kirsten.
Kirsty, Tilly and Michelle.
Okay.
And one button.
Yeah, no, that's okay.
George.
Tēnā koutou katoa. Through the chair, we're quite excited to present our final quarter report and closeout report for the 22 to 25 climate and biodiversity plan. So we'll just give a couple of highlights. When council approved the adoption of the 22 to 25 plan in June 2022, it was council's second climate action plan, but actually the first to recognise the importance of integrating biodiversity and climate action together. So in the last 3 years, we have seen an ecological restoration and biodiversity action ramp up significantly, reflected both in the work that we're doing at council, but also what our community is doing. And we've also worked hard to develop and grow partnerships with community groups and other organisations who are leading the way in climate action and biodiversity restoration. And we've highlighted some of the fantastic work that these organisations have done in our closeout report that's attached to the council report. The key theme for the next climate and biodiversity plan, which goes from 25 to 28, which is being finalised at the moment, has a theme of accelerating transformation through partnership. So we look forward to continuing to build those partnerships and working with our partners to deliver the next plan. Internally, we've also improved the way that we work across divisions and departments to do better, to integrate climate and biodiversity action across everything that we do. So we'd like to acknowledge the team effort across council for everyone who's been involved in delivering actions within the climate and biodiversity plan. However, as culture change can take time, you'll see the process of embedding climate and biodiversity considerations into council decision making carried across to the new plan as well. Also, as we report to the Audit, Finance and Risk Committee in the following 3 years, we'll be providing more of a climate risk lens to the way that we report. So as we close out the 22 to 25 plan, I would like to thank this committee's feedback along the way. And we'd also like to acknowledge the climate reference group that's guided us and challenged us and provided that national and international context around best practice. So I'd just like to hand over to Tilly, who can provide some key highlights from the 3 years.
Thank you, Kirsty. Yeah, I just wanted to highlight a couple of the key points from the closeout report. So of the 81 actions in the plan, 95% of them have been in progress or completed, And I think it is probably worth noting that the in-progress ones are hard to mark as complete because they're often business as usual or take, they're ongoing, particularly the ones within the organisation. We've achieved some amazing milestones, both within our organisation and the community, with the help of some of our amazing partners, which Kirsty has touched on. We've achieved Toitū carbon reduced certification, and this has been a huge commitment internally. Doing both, getting the certification, but also undergoing the audit process. This has helped us to understand opportunities for emissions reduction going forward. Both the long-term plan and 30-year infrastructure strategy prioritise resilience and climate adaptation as part of the infrastructure decision-making process. Project Tohu, which is an enormous ecological restoration project. We've collaborated with dozens of local organisations to support climate and biodiversity-linked outcomes across the district. So that's the likes of Lightfoot in the active travel space, WOW with food resilience and the launch of the Southern Lakes Kai Collective, Southern Lakes Sanctuary in the conservation space, contributed to Event Waste Emissions Reduction Guide to help with sustainable events. And that is just some of the organisations we've partnered with. But I think this stands us in really good stead going into the next climate and biodiversity plan. So on that note, we'll open up for any questions.
Yeah, let's open up to questions, comments, thoughts.
All right, a couple of questions. Just, page 93. Just a comment about how embedded where climate action is and all the things we do in council. There's been a few comments made by councillors that we're not embedding climate action into all of our activities. Now here you're saying they are. Have you got any comment on that? I'm not wanting to argue about it. I'm just wanting to
So, culture change takes a while. And also we've been learning along the way, particularly that integration of climate mitigation, adaptation and biodiversity, and trying to take an approach. So to change the way we consider these things in decisions and processes, it's not an overnight fix, and we're committed to doing better in the next plan. So you'll see that as a key action in the next plan as well.
Okay, thank you.
Through you, Mr. Chair, just add as well that I think it's going to be a continual work in progress. We have change of staff, we have change of priorities as an organisation, reforms happening, having to sort of weave in, processes and practices aren't static. So it's about being vigilant and diligent and making sure that the work's been taking place in a really integrated way.
Okay,
thanks, Phil. Oh, well done. Really impressed with what we've done over the last 3 years. So you should be very proud of yourselves. My only question was around the paused actions 1.11, the developing and delivering a standard method assessment of climate biodiversity impacts, review policy and bylaws, and I was thinking hopefully the spatial plan as well. I think it's quite critical that the next training that is a priority, just in terms of how fast growing the district is. To ensure that we don't lose opportunities because we don't have this sort of assessment in place.
I think that's a really good point, Bill. The spatial plan is informed by the climate biodiversity plan, and the next generation of it will be as well. As we move into regional deal conversations and thinking, that will also help shape how these the next spatial plan comes together.
Thank you. Any further questions, Lisa?
Thank you. Following on a little bit from what Councillor Cox said and looking with positivity towards accelerating transformation through partnership in our next plan, councillors had raised questions around whether we're integrating it enough into BAU, and having just come off the hearing panels on environment in Queenstown Hill, it was actually really reassuring to see how much of those reserve management plans is BAU, the wildfire risk management, the biodiversity goals. I am getting to my question, sorry. What we queried a lot with ourselves there is Project Tohu has set this really aspirational level of delivery that we will want and want to aspire to across our other reserves. Could you comment on things like that, where we sort of have got now this level of BAU kind of planning in, but at the same time we've now come in with a layer of aspirational wanting to lift ourselves up to. Does the new plan step us towards that? Is it quite a sea change leap? How do we progress towards these really aspirational outcomes of things like iconic backdrops to our community with such restraints on our funding and resources?
Yeah.
Yeah.
Shall I take that one? Yes, acknowledged. I think we will always be trying to aim high, and but we do have to acknowledge the reality as well. So in the work that we do going forward, we'll be guided by best practice such as the optimal biodiversity mapping and guidance from ORC on what should be planted, the habitats we should be restoring. So it may be a work in progress. We may not be able to get there straight away, but we'll definitely be aiming high, and hopefully that focus on partnerships will help us get there.
Will help us nudge up to those aspirational levels. So rather than saying this might be a little bit more realistic around what we can achieve, our aim is to keep the targets high and to work on partnerships to get us there.
I think it will always need lighthouse projects. So recognising and understanding when we have a lighthouse project where all of the factors are coming together nicely will be really, really important, because that will help guide and shape our thinking into the future. But yes, there will always be some degree of peaks and troughs as to how we move forward with projects.
Some of the challenge, I suppose, was in saying if that lighthouse standard is, should we limit ourselves with not applying that across all of our aspirations, or really let's keep that North Star out there that month that we get out there and go for it.
I think you know how we lean, but I just wanted to highlight there has been an incredible amount of work done by community groups. If you talk to both on this side and the other side of the hill, we've got 72 groups working on council reserves, and so they're setting the standard quite high for us.
Yeah.
So I think we probably need to be careful not to philosophically constrain ourselves and talk copy our projects, because for every individual project there's a different set of funding circumstances and parties involved that will offer opportunities. So I think that's what we've got to keep an eye on.
Okay, thank you. So, yeah.
Thank you for that. And all the good work that's been done and will be done, and we look forward to receiving the 25 to 28 plans. So thank you. So I'll move that we note the report. We've got to see Bill. All those in favour? Carried. Thank you.
Thanks.
Take the report as read. So if there's anything further you'd like to add, moving up to comment.
Thanks, Paul. Yeah. Probably the big issue has been between our meetings has been the change around ownership with buyout by 94 feet of Centuria. What do you see as the issues or risks with that going forward?
Well, all the arrangements that we currently have with the developer remain, particularly in respect to financing and funding of the project. Obviously, Centura had pretty big access to capital. Their risk profile was, I mean, I can't speak for them necessarily, but I understand they wanted to leave the partnership. And by leaving the partnership, they're effectively wanting to leave the project. So having a 100% committed partner in 94 feet, it could be said that's a lower risk for us. Nonetheless, 94 feet, while taking on all the guarantor and security requirements that were previously in place, they are still having to work on that finance side of things and the funding for the next stage. So I see that's probably an area But from our perspective, all the requirements for settlement remain in place.
Do you know why they decided to sell out to the 94 feet?
Like I said, all I'm aware of is they wanted to leave the partnership. My understanding is they're involved in quite large format commercial space, and they have a different risk profile in the Lakeview development, on 94 feet, and everyone includes it.
So their view of the risk hadn't changed or had changed?
Well, like I said, it could be said that the risk profile is reduced in that 94 feet wanted to take on 100%, and their minority partner is wanting to leave. And if they wanted to leave the partnership and leave the development, that would be a potential sticking point going forward.
Mark?
Just on the program there, the milestones, I suppose, satisfactory stage 1 settlement conditions expected to be within the next 6 months. Then commencement of construction. Is there any update on construction commencement from your understanding of where we're heading with that?
Yeah, Lyle, in the previous report, we were reporting within 6 to 12 months, and the progress since then is it's now within 6 months. The developer is working very closely with, or actively engaged with our property team, our infrastructure team, the consenting wing separately as part of their own consenting, and also legal around some of those conditions around settlement as well at the moment. So we're at the moment we're looking at within the next 6 months.
So if it's not within the 6 months, is that considered a not achieving anything we've formally got in place, or is there how do they keep it? We keep adjusting these dates.
Yeah, so there's in table 2, I think you're referring to.
Yeah.
Yeah, so the satisfaction of stage 1 settlement conditions was 21st of April, and the commencement of construction 21st of June. So they're rolling milestone dates, so they don't have a fixed component.
Okay.
So they're kind of hinged off our program, and then they move forward. As I said before, the developer is actively engaged with right across council, and they're keeping us informed as to their program. The fixed settlement sunset date, which is next April, that's within that next 6 month period. So, you know, there's obviously a discussion to be had if they start to go there, and we'll work through that at the time. But at this point, we're indicating within the next 6 months. So the sunset date, you know,
should be achieved.
I think it's probably quite important to, well, I mean, our own target dates for completion of the council works will, you know, they were part of that flexibility in the program, and that was envisaged right from the outset. So, yeah.
Yeah, thanks, Mr.
Okay.
Thanks, Mr. Chair. Thanks, Paul. Appreciate the report again. Just I guess at a high level, I suppose, are you aware of, or I guess 2 questions maybe, if you can sort of give us a percentage of the way through satisfaction of stage 1 settlement conditions, like are they 50% there, are they 75% there, are they 20% there? And is there anything in particular that we should know about that would give us concern that potentially they aren't going to achieve those stage 1
milestones?
I mean, like I said, we're working with our own legal team looking at those at the moment, and probably the area where we've progressed since last time. I think the deferred stormwater works was an outstanding issue in March. Since then, we've actually closed out the commercial arrangements between the parties on that. So there's now quite a clear pathway for delivery of that. Notwithstanding that, they still have to go through the consenting and side of that. So that area, in terms of the milestones and the settlement dates, and that is probably an area of risk that we're still managing, but in terms of the developers' engagement with all those teams, to work through that, they're progressing well, and that it's not like they're not engaging and stuff. So if they weren't working with those teams, I would be more concerned than I am now.
Thank you.
Thank you. Thanks, Paul. Just to go back a little bit to Bill's question about the ownership of the developer. So you see that anything has changed for 94 feet now in that they didn't take on 100% of it in the first place. What led to them having the 25% partner in the initial setup, and they don't need that now? They can now own 100% of it. Is there anything you can rule on that?
Yeah, that would go right back to the bid stage, I guess. Centura originally were a New Zealand company, Augusta. Yeah, and then they were bought out by Centura, the Australian counterpart.
And I'll just add there, they defaulted on 2 deals as well.
Yeah, so as I alluded to with Bill there, they wanted to exit. So I don't think it was a matter of wanting to retain them for any particular reason. If they want to leave the partnership and leave the development, and looking at various ways which they could do that, both under the DA and independently with their own 94 feet. They were exploring all those options. So, yeah, like I said before, I don't think it really is a matter of retaining them for a particular purpose.
So my reference was to Augusta, defaulted on 2 deals before they were taken over.
Right. And I guess the question I've also got is, did the development agreement anticipate that this might happen? And I'm not sure if it covers it anyway, or even if it would already, but now that it has happened, is it a significant change? Is there an effect on the agreement itself? And does it need to come back to full council for any agreement on it, or is it covered by the delegations?
Yeah, it's covered by the delegation. I've updated attachment A, decisions of council, so on the 2nd of May, Chief Executive granted consent for 92 feet to do that buyout. There was a specific clause within, there is a specific clause, so it was anticipated within the DA, not to be unreasonably withheld, etc. And because it's a minority partner that was exiting, it was anticipated.
Okay. The other questions I've had.
Oh, just to add to that, and to make the point, the same equity commitments in paragraph 10 from the developer and all conditions on the developer currently under the DA remain with the Century. So in terms of, you know, the due diligence at various stages, securitisation, the underwriting of the guarantors from 94 feet from Augusta, that's all taken care of.
Thank you. The other question I've got, the council's works to do with the subdivision and any remediation, is that complete?
Well, not in its entirety. There's deferred stormwater works, which the developer is going to do. There's also the Market Square, which is in the future.
But in terms of the developer being able to start stage 1, all the council side of that work is completed, rest for them to start.
Yeah.
Okay. Yeah, that stormwater issue that's come up before too. Obviously, there's work still to be done on that. The council is going to do that. Is that right? But they've deferred it, and the developer may do that work with council input. Is that correct?
Yeah, there was a bit more detail. I tend to remember the discussion last time around, you know, the budget for that, and we indicated that we were in negotiation at that point. The commercial arrangements, which we've closed out now, are consistent with our existing budget. So,
one of the big risks that stands out to me for that is, you know, what's happening with the hillside above the site over the long term, and how do you design a stormwater system to accommodate what might happen in the future with the removal of any trees on that site, and whatever other stormwater collection might happen above the site as part of that work, which is you know, currently not funded to do, but is a desire to have achieved at some point.
yeah, I mean, we we've gone through a consent process, and decisions of council and decisions of, the consenting team in terms of meeting 2247 requirements there, for a certain requirement. I think what happens on the Ben Lomond Reserve in the future, there's, probably an opportunity around that, but who pays for that, is probably, up to, a different, further process. I know that the developer and the construction team met with the Parks and Reserves team with P&I yesterday on this very topic. So it's something that they're working through.
And my final question, I think, will be, obviously there's been a cost and maybe higher cost than anticipated in the council works that have been carried out to date. And I don't know whether you have any figures, or even if you're able to present them here, but is there any visibility into how those costs relate to the settlement costs for the stage 1 lots, I guess, or the overall lot prices that we are anticipating in the future?
I'm not aware that the budget is consistent with the budget last approved. Well, I forget when it was, council decision on that. I think it would have been July 22 before the, so it's right. Yeah, so I don't know what cost overruns or additional cost you would be.
Well, maybe it was covered back then, but I understood there was some remediation that was required for material that was, asbestos. That was talked about.
Yes, but there's been no change in that.
So that's still covered
for some time. Yeah.
By that funding that was allocated back in July 22.
Yeah, and I think I made that, would have been at least a year ago. Those budget projections were met based on 2001, 2002 figures, and through that time there's been there was 3 years of quite a lot of inflation. So for the project to be delivered within those original budgets is actually probably quite
2021, 22 budgets.
Yeah, 21, yeah, sorry. Yeah, so it's, I mean, there was the issue around the ancillary works and some of the other were not related to the DA in the subdivision.
Yeah.
But yeah, it doesn't relate to the DA in the financial figures and the land deal that you're talking about.
We have noted that those figures have been conflated and misrepresented.
Right, thank you. That's thank you. Please.
Thank you. Our community are looking at a predominant development site out there that's still empty at the moment, and at the moment they're equating that with mismanagement. I'm not seeing any flags or evidence of financial failure or default or insolvency or anything like that. Delay in delivery risk, yes, but not failure, not financial risk. Would you be in agreement with that?
I mean, the importance of that land, both in value and I guess what goes on the land is for the community and for council's decision making. I understand we've been through quite a long gestation on that and worked through that through various consultations and decisions of the council. The settlement obligations on the developer, because of the value of that land, is set quite high. The bar is set quite high in terms of them meeting the financial requirements, making sure they've got the consenting in place, making sure they've got full construction contracts, etc., and that. So I guess the delay at the moment is ensuring that bar is set, because that's the leverage we've always had, which is the continual ownership of the land. Well, not continual, but up to a point, and then there's a handover. So while it's called a deferred settlement model, council was happy to go into that model because of that value of the land and the importance, not necessarily financial importance, but it was making sure that something got delivered at some time in the future. Last time we were in this situation, it was 2002, the GFC came along and the developer had to pull out of that. So the deferred settlement model was adopted by council to ensure that it happens, but maybe not necessarily straight away. So it was, the timeframes were limited. So I guess the concession for the developer in this, and around why there's some flexibility in some of the dates and milestones, is if there's going to be a high bar set, where they need all their ducks in a row first before there's a settlement, there may need to be some flexibility in the timeframes and stuff. And that was back through the negotiations, that's what we worked through at the time. So it's coming, it's just going to take a little bit of time.
Well, it might be helpful to just share, I'm not sure if you can recall the sales figures that have been publicly released, because I know that when we saw the pre-sales figures, that was quite exciting, and that makes it seem very real.
I have heard from local real estate agents that they're selling well, so that's correct. Another question, I've just got two more questions here. So what I'd like is to help our community understand 2 points. One, sort of what's happening, what's already been delivered, and sort of are we on track? And I'm wondering about some sort of simple visual, almost like a timeline that says, hey, this is where we're at, but also that we might just, as well as a timeline tracker, develop some sort of simple FAQs around addressing some of these regular queries that we get, particularly around the bits that people are frustrated about, like the visible delays, or why the project feels hard for people to actually follow. Like if we can dive down into some of those deep drill bits. And I suppose another bit that I'm curious about, which I don't really see a lot of our focus on at the moment, is it's not just about the cash that we get out of these, it's about the other longer term benefits of accommodation and jobs and public spaces and those other value bits. And I'd like to see perhaps some way that we can track some of those benefits over the longer time of what other value are we getting from this site, because a lot of our focus is just on when are they going to pay us some cash. Yet when you look at that predominant development site, it's going to be an iconic anchor for this CBD area. So I'd just like to see us perhaps turn some of our focus to the wider benefit map of this project, and perhaps give some visibility around that for our community.
There is an original set of objectives which are not financial in nature. You're quite right, Lisa, and we could perhaps bring that forward and revisit.
Yeah, because I think it's getting to that exciting bit now of the infrastructure works being in place. We know we've got some challenges just around operational delivery and things that we're still walking through. But I just think that this constant harping back to slightly misconstrued or misunderstood bits like super profit clauses or whatever else that we bat around in the ongoing tennis game, that if we could be a little clearer on giving our community ways to understand the bits of the project that have been hard to follow. How else could we explain some of that?
Yeah, I will highlight that that is part of, I guess, this reporting is also 6 monthly updates from the developer. So there will be a full council workshop, which is public, where the developer will come and
Is that the 19th of August?
On the 19th of August.
Because I wondered about even a public session with the developer, maybe like a pop-up somewhere or something in the coming months that might enable.
They could come out of the meeting.
Yeah, something like that.
Yeah, excuse me, I maybe been working on this for too long and too close to it, but it's probably, it's got to the point, I think, where breaking ground and them actually getting started on site is very important.
Once we get some visible action happening.
Yeah, and so it'd be nice to, rather than say, well, it's going to be, we're talking about something in the future, it's actually starting to deal with that. So I guess the changeover now, particularly for this first stage, I think it's really important that the first stage is, it's a key milestone because things will flow from there. The first stage is upward of 300+ million in construction, pre-sales, at least over 50% of that. But I guess the next 10 years of billions of dollars of development will come off the back of that, and I think that's where the proof of the point.
And I think there'd be some value in looking at that benefit and keeping some kind
Keeping
of
that
bracket over the coming decades of it becoming.
If I just had a quick look, and there's a really significant project landing page on our website. It's got all of the concept and vision. It's also got all of the project history and project objectives. So there's quite a significant amount of information there, but I think we could pick up on some of your
like a one page, because I agree there's significant information out there, right? But where's out is really quick.
If people wanted to find out about Lakeview and all of the context, they can happily find it, but we'll review that.
All front for them. Yeah.
Right.
Bill, did you? No, nothing further. Okay, thank you very much, and some very good questions. So on that basis, I'll move, and got a seconder? All those in favour? Carried, thank you. Annual privacy update. Ryan.
Right.
Right, we'll take your paper as read, but well, is there any further comments you want to make on the paper?
Thanks, Chair. Just quickly to explain the whole, there's three main purposes to the report. It's an annual report. It's to report back on organisational capability and compliance. There's a number of points that we've made in there about things that we've done during the year to improve that. We report on the number of requests made under the Act, and we also give a summary of privacy incidents, how they've been responded to. So that's all in there. Happy to go through any of it in detail if you need to.
I'll open up to questions. Bill.
Oh, thanks for the report. Sounds like you're making progress. I guess for 226, how will you know things are different and improved? And is there a simple metric you can use, like the number of privacy incidents? What is the benchmark? Is it 10 a year or 100 a year or whatever? Just so that you get a sense of progress and change.
Thanks, through you, Chair. I would say it's quite difficult to put a metric on it. In some senses, the more privacy awareness there is, we notice the more privacy incidents are reported through and are dealt with. Probably the most significant sort of measurement would be making sure that there's not recurring or systemic issues in relation to privacy. So, for example, we'll have incidents where people accidentally CC'd in, or their email addresses or their personal information is released as part of a process that we use over and over again. And so increasing that awareness and stopping those inadvertent breaches is a way that we can show that we're improved. So that's what we look at in terms of privacy incidents, and whether we're dealing with things and stopping them from happening again. The other thing that I'd say, and the focus that we've highlighted for this coming year, is around privacy impact assessments and building more internal capability to do those quickly and embed them in other processes like procurement, software, subscriptions and that sort of thing. Did you want to add anything on that?
Maybe in the next report, you could have a table with the different types of breaches, just to show how many, and that way you can look at the trend, and that'll tell you whether there's a red flag that goes up around a particular type of breach.
Sure. Thank you.
Thanks, Bill. Yes, Kevin.
Just very quickly, obviously, we all learn from our mistakes, and some of these
Well,
mistakes.
yeah.
It's a good thing to do. It's also good to be able to learn from other people's mistakes. The ORC, I know, had a privacy breach, and then they doubled it by doing it again when they notified all the people that they breached. Have we learned anything from that as an example, so that we don't do something similar?
I would say our organisational capability and understanding our privacy obligations and and how to respond to situations, and just having privacy as part of that response, not necessarily purely to privacy issues, but as part of any sort of incident. That's a capability that all organisations are working on and trying to improve. As you say, everyone makes mistakes, and when new people come into the organisation, we need to make sure that they, they've been onboarded in terms of privacy and have it as part of, their sort of the framework they're working within. I would be hesitant to judge any other organisation who's made a mistake like that, because it's all down to people, and people do make mistakes.
I guess the question was more about understanding how they made the mistake.
Yeah.
Putting in place measures that we don't do something.
Mitigations,
Yeah.
Because obviously they didn't intend to make that mistake.
Yeah, through the chair, responding to your question, I signpost you to the incident response plan that we've developed as well. And I feel like that would help to remedy any issues, and also then lessons learned from other organisations to bring this point, human performance, mistakes do happen, but it's a great opportunity to learn as well.
Great.
And we do keep an eye on the trends across the Privacy Commission. I think that the trend was for local government, about over 50 privacy breaches have been all related to ratings. So that's a good trend in the enterprise as well to keep an eye on.
And Katie, our privacy officers meet on a regular basis, and you do look at lessons learned across the sector. Yeah.
Correct, we meet monthly.
Right, thank you. Okay, no further questions. Oh, please.
Sorry. So you're just reading through the report, all the breaches are all numeric, or by the look of it, or something like that. Are we continually under attack as well? Like, are people trying to actively steal our information? And are we confident that, I know it's not really covered in here, but are we confident that privacy or the information that we hold is protected? I guess it's more an IT level and stuff.
Yeah, through the chair, information security is something that we are working on continuously. It isn't covered in this report, and it's pleasing to note that none of these privacy breaches have come about because of a cybersecurity breach. And in fact, we haven't had any serious breaches in the past year, touch wood. We do bring cybersecurity related risks to the AFR, and when there's material changes, but a significant amount of effort and resources put towards information security and making sure our posture is good. And we're adding new things. Just in this last month, we've added an improvement in our Cisco umbrella, which is protecting us from the web. So there really is continuous improvement, upskilling of people in terms of training in that cybersecurity space.
Right. Okay, we've got a mover for the noting of the paper. Bill? Kevin, all those in favour? Carried. Thank you very much for your report. Eddie? Looks like we're going to go miles at a time, but there's been some good debate, so.
Negative one. But it's really what I've asked.
What's that?
But it's really what I've asked.
We've gone, but. Okay.
Right, hello. So this is the April year-to-date financial update. So just some key headlines for the committee. Overall, forecast by the end of the year to be neutral there. So that's pretty pleasing for us. We do have a major variance within our development contribution income. There's a bit of a difficult line item to manage, obviously, developer dependent, and it's with our growth as well. So it is something we want to look into, and it's got on our radar for the next 12 months. And then CapEx wise, we have embedded the traffic light system now. You would have noted in the reports there is a few groupings with amber and the red traffic lights in there. I've got a bit more detail about that within paragraph 10. So a lot of the reasons there is the timing. sort of been due in part to just a late sign off of the LTP. Also within the report is a treasury update and the debtors analysis as well. We have taken the report as read and happy to take any questions with that.
Yes, Mark?
Yeah, well, a lot of information here. Just understanding when is this, you talk about deferring stuff from the end of 30th of June. When is that reported to council? And is there a reforecast or something at some stage? When's that?
This is standard annual paper. August,
So it's the early September meeting, so we have to wait till end of July for the final actuals that we accrue into June.
Okay.
And then closing following council.
Just on some of this, the earlier snapshots on the percentage of the high PMO renewals and other, and then the forecasts here, so they seem to be changed. They've changed from a little bit from the snapshot we had. We had some information provided not long ago. Are these forecasts now pretty certain? They will be, because you've got almost, well, you've got to wait till the end of July for that.
It's definitely optimistic, but I think we'll be in the range, you know, it might be 1%, possibly 2% under, but we need to hit, big month of close to 16 million spent. So we've averaged 11 million year to date. There is some bigger one-off costs we've already seen come through. Almost $1 million for a land payment for Upper Clutha wastewater. We've got 500k for the Valentine Road Sports Centre, so one-off payment. So there's a few things which are just trended towards the end.
Okay.
But the forecast is still 88%, but it is optimistic.
Okay, yeah. Okay, yeah. Well, we can through the infrastructure committee, we can talk more about the renewals and things like that, issues there. But okay, that's all, Mr. Chair.
Thank you, Mark. Any other questions? If not, I'll move, noting of the contents of the report, seconder. Thank you. All those in favour? Thank you.
Yeah, great.
And so annual plan. So this, it was approved at the council meeting on the 26th of June, so I think we should just note. Comfortable with that. So Bill, you'll move. And I'll second. All those in favour? Carried. Thank you.
A lot of information there.
Heidi, I see Mike's there as well. Welcome. Welcome to you both.
Thank you.
Yeah. Okay, floor's yours.
Yeah, well, I'll just introduce it. So I think for the most of the committee will be familiar with me. I've been the legal partner for the last 5 years. It is under OHM rules a requirement to rotate the lead audit partner in 6 years, which was intended that Hayley would come in to the QLDC audit next year. We have had some challenges within our partnership with a health-related matter, which has meant that we've had to rejig things and call it forward more quickly. So we are transitioning the audit to Hayley this year, and I will be stepping out but supporting that transition process.
What's that noise?
I'm not sure it's Chairman.
Sorry.
That's fine. And so, yeah, Hayley is a very experienced audit partner from our Dunedin office, has looked after a number of councils, and with the benefit of a planned and staged transition, I mean, working closely with her, I think we can do that with minimal fuss and impact to QLDC. So we're well advanced in that transition already. So I'll hand over to Hayley to talk to the plan.
Thank you, Mark.
Well, nice to meet you all in person.
Yes.
So, thank you. Appreciate the time to be here. I'll just call out a few things just around the report. So I think there's 3 things in your pack. There's obviously the audit plan, which is our report to you around our areas of focus for the audit, and also the audit engagement letter and audit proposal. Now, you normally sign an audit engagement letter for 3 years, so actually you already have one in place that covers this year's audit, but just because of the transition from Mike to I, and because we are personally named as the appointed auditor, they've just been reissued with my name rather than Mike's. And similarly, the audit proposal letter comes through each year with the fees related to it, so they're both in your pack. From an audit plan perspective, I think you will all be very familiar with what you've seen, what you've read already. There's no new areas of audit focus. So everything that's there has sort of been really the areas that we've continued to work on in the past. Probably just to call out one of the big areas is the property plant equipment valuation.
Yeah.
So you do have your infrastructural assets at fair value for your roading and your three waters assets. The water assets were valued last year, so are not in rotation effectively this year, and there has been an assessment done around material movement and noted that that's not occurred, and probably similar to the discussion you had with the airport earlier. When you do a desktop assessment, you don't need to then go further if that's okay. And that roading valuation is in play at the moment, so it has already been done, and our teams are actually already working on that at the moment. So that's probably the main area was calling out, and I guess really open it up to you if there's any questions.
Any questions around the table? Oh, you got to.
Just a quick one on, I've read it, most of it in there somewhere, but anything that comes up on a sort of on a legal basis in the audit, how do you address that? Do you have a lawyer in the audit team?
No, we don't. No, we don't. But there's a number of things we do, but we obviously get in touch with, as part of it, we look through legal representatives that used external to council, but also in-house representatives. So we go through that process and look for anything and discuss anything that comes out of that in terms of potential litigation. We would then re-engage if we need to around specific things, and you would have seen that perhaps in the past around leaking home issues and things like that, where that's had to specifically happen.
Any other question at all? No? Thank you, and nice to meet you in person.
Thank you. Wonderful.
So I'll move that we. That up is, sorry, so we've got note the contents and also recommend to council that the signatories sign the engagement letter and audit proposal letter on behalf of the council. So I'm happy to move to the second level. Thank you.
Just a quick question, who is the secretary?
So the chair of the Audit and Risk Committee signed one of the letters, and the CE signs the other. Yeah.
Okay.
We've never done that before.
No.
I just thought it was formal, getting that formal delegation.
Yes.
Thank
you. Okay. Thank you. Thank you. Insurance update. Gareth.
You've been waiting for this.
He's been waiting, that's right.
First and last. We are hoping to have Bridget, our senior insurance advisor, with us shortly. So any difficult questions, obviously we'll wait until Bridget's here. Just joking. Through you, Chair, happy to take the report as read. There's just a couple of items that I would like to bring to your focus with your permission.
Yep.
So as you can see in the report, we are currently entering into a softening market for insurance. We haven't said that for what seems like the whole time I've been reporting on insurance, if I'm honest. Reasons for that are increased capacity and the willingness in the reinsurance market to engage again after a difficult period for them. That's given us, I suppose, a few opportunities, but the current circumstance we find ourselves in for insurance is relatively challenging, and we're obviously working through that as the report outlines. I just want to touch on some of those challenges. So Three Waters reform, water done well, obviously is going on across the country, and council is currently consulting or have consulted on the future delivery structure. Most of our catastrophic event insurance for local authorities is placed in London market, and that London market placement has for many years relied on existing collective policies, and we're a member of that through the South Island Collective. So we're currently in the process of understanding what that means for us, and the initial, I suppose, transition to any CCO structures. It is possible for policies to be transferred over to CCOs, water service CCOs. But some of the details of that are still being worked through, so obviously we'll bring that back to you. That's probably the major challenge for us. Experience from Aon with other collectives going through the London market has been reasonably favourable. We're always challenged, obviously, with increased number of assets as we grow. Our asset value goes up, replacement cost goes up, but we're likely to see a proportional reduction in our premium. And obviously, we're working through that process. Bridget has looked at a number of alternatives. I know the Audit, Finance and Risk Committee asked us to see whether we could change or review, reduce our risk exposure by considering other collective agreements. We have talked today with other councils around potential different approaches away from the collective agreement. Given what we've done well and where we're at the moment and the position other councils find themselves in, that just isn't really an option for us at the moment. So her recommendation, obviously, for the softening market is that for this point in time, we'll be putting to the London markets a similar collective agreement. Additional controls for us in terms of a legal agreement between members of the South Island Collective. And we're also able to now reduce our cost of loss modelling. The London markets, as the report indicates, has provided some funding for loss modelling. We, as a council and most of the other, if not all of the other South Island collectives, have not done loss modelling since 2018. Reasons for that is obviously COVID and other issues have delayed that being meaningful for us. So we're now in a position, QLDC have taken the decision to do loss modelling in preparation for November. It gives the market much more confidence around what they're taking on in terms of risk. And then we're locking into the legal agreement that we collectively do loss modelling at least once every 5 years to a common agreed standard.
Right. So in a softening market, it's time to get better terms as well, and the wordings and the policies. It's just not about reducing premiums, it's actually getting better terms and conditions.
Absolutely, and obviously us getting a contribution from the market to do loss modelling is just the start of that. We have a number of things that we want to look at, potentially lifting our programme limit, which is our collective cover under the policy, working with the other councils on that, but that seems like something that we might take an opportunity to look at based on the premiums that we have in front of us.
Right. Any other questions? No? I'll move. We'll second it. Lyle, did you have something?
I just, we actually operate drones, do we? Got a drone insurance.
So we do. I believe we have one drone. It sits in
GIS. Yeah, for GIS.
Cool.
There we go. Okay, it's been moved and seconded. All those in favour? Aye, carried. Thank you for the update, Karen.
Thank you.
Right, I'll move that we move into public excluded. We've got a second for that. Thank you, Bill. All those in favour? Carried. Thank you.